Hey everyone, welcome back to Finance Sphere. Are you guys currently holding any Ethereum? Right now, if you scroll through crypto Twitter or any community feed, it feels like everybody is dunking on Ethereum. People are pointing out that while basically every other asset class has pumped, Ethereum has stayed dead flat or even dumped, and the jokes and hate surrounding Ethereum as a store of value are at an all-time high. On top of that, rumors and frustration have been boiling over recently following news of a series of developer exits from the ecosystem. But guys, underneath all this market noise, here's what the market may be missing. Large financial firms and Ethereum's core developers are quietly working on the next major network upgrades. In this video, we're going to look ahead to Ethereum's upcoming update slated for late August and break down the rumors and what's actually happening behind the scenes. First off, for any beginner investors tuning in who might be new to Ethereum, let's quickly cover the basics of what Ethereum actually is. Unlike Bitcoin, which acts primarily as a simple store of value, Ethereum is essentially a massive, decentralized virtual computer built to execute smart contracts. Since its launch in 2015 and surviving the infamous DAO hack, the network successfully transitioned to proof of stake through the merge in 2022, slashing its energy consumption by a staggering 99.95%. Following that, the 2024 Deanton upgrade absolutely crushed Layer 2 fees by over 90%, laying down the ultimate groundwork for mass adoption. Building on that momentum, Ethereum is upgrading standard user wallets into fully programmable smart contract wallets through the Pectra upgrade. This transforms the crypto user experience to match traditional fintech apps. Previously, users had to approve every transaction in their wallet and hold native Ethereum just to pay gas fees. With this upgrade, users can pay gas in stablecoins like USDC or USDT. Furthermore, it enables conditional automated payments, allowing dApps and businesses to offer seamless subscription billing, automated stop-loss execution when a target price is hit, and single-click recurring transactions directly from your wallet. This provides an important stepping stone for adoption across big tech, enterprise payroll, and public financial systems to move on-chain. Large fund managers running mega funds can't rely on a single human signing off on key transfers. They need programmable wallet smart contracts with custom spending limits. By turning multi-step crypto interactions into a single click, average users can interact with Web3 seamlessly, like regular mobile banking, without worrying about underlying blockchain mechanics. Looking ahead, Ethereum is gearing up for major technical milestones like Fusaka and statelessness, which will supercharge network scalability, reinforce censorship resistance, and slash node data storage requirements by over 90%. These technical milestones set the stage for migrating broader markets and administrative systems on-chain. Heavy-hitting financial firms are unlikely to migrate to centralized or fragile chains at risk of network outages or governance rollbacks. If a ledger can be manipulated by political decree or a central entity's whim, it's far less attractive for professional finance. Ethereum aims to become one of the most secure, tamper-proof, and neutral financial backbones, built to host sovereign state systems and Wall Street liquidity. If Ethereum hits these development goals step by step, it could become a primary settlement layer for real-world assets, cross-border sovereign currency issuance, an unalterable digital public utility, and the programmable engine for macroeconomics. In fact, according to market tracking, some long-term Bitcoin holders and professional investors appear to be rotating capital into Ethereum. These players are moving funds into Ethereum to capture native staking yields and position themselves ahead of Ethereum's emergence as a primary hub for RWA tokenization. While Bitcoin functions as digital gold, Ethereum serves as a broad financial marketplace. Every transaction fee generated on Ethereum reinforces the long-term value proposition of Ethereum. Just like a toll road owner earns more revenue as traffic surges, investors with a long-term view are positioning themselves ahead of the wave of capital. Treasuries, equities, real estate, stablecoins coming on chain. Despite all this progress, sentiment on crypto Twitter remains low due to Ethereum's sluggish price performance. Misleading narratives have even claimed that Ethereum is dying due to developer departures from the Ethereum Foundation. But what people miss is that the Ethereum Foundation's core mandate was always centered on bringing the network from mainnet launch up to the merge, after which development authority was meant to decentralize across independent entities. While headlines pointed out that dozens of core researchers and executives departed the foundation in early 2026, what actually happened was that these developers left to launch independent, nonprofit research labs like Ethereum Labs. This strategic spin-off was designed specifically to navigate regulatory landmines and directly interface with major financial players. If core developers build software while directly drawing a salary from a single centralized foundation, regulatory bodies are more likely to classify the underlying token as a security. By spinning off independent research organizations, Ethereum mitigated regulatory risk. In tandem, the Ethereum Foundation released its Ethereum Basics for Governments and Institutions report, providing clear legal and technical frameworks for global asset managers, central banks, and government agencies to deploy on-chain safely within existing regulatory boundaries. It's true that since the Dinkun upgrade slashed Layer 2 fees by over 90%, Layer 1 gas burn slowed down significantly. With issuance briefly outpacing burn, Ethereum experienced temporary inflationary pressure. Additionally, as activity and fee revenue migrated to Layer 2s, critics began asking, if Layer 2s are sucking up all the fee revenue, what does Layer 1 actually gain? This created a temporary narrative void that weighed on Ethereum's spot price. However, this narrative void is set to be filled with a new catalyst as we head through Q3 and Q4 2026. Industry heavyweights like BlackRock and JP Morgan are preparing for full-scale deployment of tokenized real-world assets and stablecoins on-chain. As traditional assets take root on the Ethereum mainnet, speculative retail flows are expected to be complemented by steady, professional buy pressure. Industry leaders, including BlackRock CEO Larry Fink, have explicitly highlighted Ethereum's central role in this transformation. In his 2026 annual chairman's letter and keynotes at the Davos World Economic Forum, Larry Fink made a passionate case for the macro shift driven by RWA tokenization, stating, "Where crypto and tokenization are today is right where the internet was back in 1996. The tokenization of every asset class, stocks, bonds, ETFs, real estate, is an inevitable evolutionary step for global finance." While major institutions are testing multi-chain strategies, looking at where capital concentrates reveals that Ethereum holds an overwhelming majority of total value, locked, and fee generation. Over half of all tokenized RWAs globally are settled directly on the Ethereum mainnet. Meanwhile, Bitmine, the world's largest publicly traded corporate holder of Ethereum, continues to stack Ethereum aggressively. Despite media headlines claiming Bitmine is taking massive losses on its Ethereum treasury, in reality, Bitmine sold put options contracts promising to buy Ethereum at a fixed strike price if market prices drop. When prices fell and they acquired Ethereum at the agreed strike price, accounting rules forced them to record book losses, which are purely paper accounting entries. For Bitmine, buying back their own stock at a 15% discount is actually more accretive to increasing Ethereum per share than buying spot Ethereum on the open market, making this a strategic move toward their stated goal of cornering 5% of the global Ethereum supply. To wrap things up, in today's video, we covered what Ethereum is, how its historical upgrades shaped its current architecture, and where the network is headed next. As we head toward major network upgrades and macro financial integration between late 2026 and 2027. Judging Ethereum solely by its recent price performance may overlook some of the longer-term developments taking place across the network. That's it for today's video. Thanks for watching, and I'll see you in the next one.